Trend lines are one of the most powerful tools in trading, but the problem is most traders are still using them completely incorrectly. The most confusing part about trading with trend lines is that every trader seems to draw them in a different way. Take this chart as an example. Some traders may prefer to draw trend lines by connecting wicks, while others prefer to draw them by connecting candle bodies. So, which way is correct? Even if we know how to draw them, the next big question is how to actually trade with them. Should we wait for the price to touch the trend line and enter a trade expecting the price to bounce? Or should we wait for the price to break the trend line and predict a reversal to place a sell order? The truth is, I have tried all these methods, but throughout my trading career, I have discovered the best way to trade with trend lines, which has helped me make a lot of profit. First, what is a trend line? A trend line is a straight line drawn on a chart to connect two or more price pivot points. Let's look at an example. In this chart, we can see that the price is fluctuating, moving up and down constantly. So, with all these fluctuations, how can we determine the market trend? It's simple. We draw a trend line. By drawing a straight line connecting the lows on the chart, we can see that the trend line has an upward slope. This tells us that despite short-term fluctuations, the overall market trend is still rising. Now let's consider the opposite scenario. In this chart, the price is still fluctuating up and down. However, when we draw a trend line this time by connecting the highs, we can see that the trend line has a downward slope. This means that despite short-term fluctuations, the overall market trend is still declining. A question you might ask is, can't we determine the market trend just by looking at the chart? Why do we need trend lines? The answer is very simple. Trend lines not only help us identify trends, but also help detect entry points that we might miss if we rely only on our eyes. For example, in this chart, we have drawn a trend line by connecting the lows. Notice that in the past, the price tended to bounce up whenever it touched the trend line. This tells us that in the future, if the price approaches the trend line again, there is a high probability that we can expect another bounce. So, a potential entry point here would be to place a buy order when the price retraces to the trend line. The second reason why trend lines are useful is because when the price breaks a trend line, it can signal a possible trend reversal. For example, in this chart, we have drawn a trend line by connecting the highs, and it shows that the market is in a downtrend. But right here, the price has broken the trend line, and right after that, the trend shifted from down to up. Knowing this, next time the price breaks a trend line in a downtrend, we can place a potential buy order. But remember, the examples I just gave are ideal cases. In real trading, we cannot simply enter a trade every time the price touches or breaks a trend line because these patterns rarely work in isolation. We need to combine other factors such as price action to increase the chances of successful trading. To draw a trend line, first, we need to identify something called swing points in the price. A swing point is when the price moves to a certain area and then moves away. For example, here we see the price dropping and then reversing upwards. The lowest point before the price reversed upwards is called a swing low. Our task is to find as many of these swing points on the chart as possible. In this case, we can see multiple swing lows right here. However, it is important to only mark significant and easily recognizable swing points to draw a valid trend line. To draw a trend line, we need at least two main swing points. In this case, we have more than 2 points, so now we just need to connect them with a straight line. Should we draw it touching the wicks or the candle bodies? The answer is to use whichever method results in the most touches. For example, looking at this chart, if we draw the trend line touching the wicks, we get 3 touches. If we draw it touching the candle bodies, we get 5 touches. So for this specific chart, we will draw the trend line touching the candle bodies because it has more points of contact. Additionally, a trend line should be seen as a zone, not an exact line. As long as it stays within the general area of the swing points, the trend line remains valid. It doesn't matter if you draw it slightly higher or lower, as long as it stays within that zone. Now, if we look at the price action above, we also see multiple significant swing points. Let's try drawing a trend line. If we draw it this way, some swing points do not align with the trend line, which makes it incorrect. But if we redraw it like this, the swing points align correctly with the trend line. This is the correct way to draw it. Let's see another example for further clarity. Step 1. Identify the key swing points. Here we have multiple clear swing highs and swing lows. Step 2. Connect the swing points to draw the trend line. In summary, the key to drawing an accurate trend line is identifying significant swing points and connecting them in a way that results in the most touches. Don't worry if you don't get it right the first time, because the more you practice, the better you will become. Now that you know how to draw a trend line correctly, I will reveal a high probability trading strategy that I use. The principle of this strategy is to view the trend line as an important support and resistance level. Suppose you have a trend line drawn on the chart. When looking at it, you notice that the price has bounced each time it touched the trend line in the past. So in the future, we can expect another bounce. But that doesn't mean you should buy immediately whenever the price touches the trend line, because this pattern is not always reliable. For example, in this chart, the price previously bounced when it touched the trend line, but this time, instead of bouncing, it broke below. If you buy blindly, you will incur losses. This is why you need a better approach. This is the strategy I use, and it has helped me make a lot of money. The first step is to identify a valid trendline setup. As shown in this chart, we can see that the price is in an uptrend and has swing lows that we can connect. So we draw a trend line here. When the market is in an uptrend, we expect the price to bounce. Therefore, we only need to draw the trend line below. Next, I use a stochastic indicator. To apply this indicator in the indicator section of your charting platform, type stochastic and select it to add it to the chart. After adding it, we need to change the settings to the custom parameters I usually use. Go to the stochastic settings and copy these values. This will help the indicator provide more accurate signals. Once the tool is set up, we can start looking for entry points. What I look for is when the price approaches the trend line while the stochastic's blue line moves into the oversold zone, which is the lowest area on the indicator. This scenario would look like this. However, as I mentioned earlier, we consider the trend line as a zone instead of a fixed line. This means the price does not have to touch the trend line exactly. As long as it remains within the trend zone and the stochastic cuts into the oversold zone, the setup is still valid. For final entry confirmation, we wait for the stochastic to cut back into the oversold zone. When these signals are met, I open a buy order. Risk management. Place the stop loss just below the nearest low. Take profit at twice the stop loss distance. As you can see, the price bounced and hit the take profit. Therefore, the key to this strategy is using the stochastic indicator to confirm signals, helping to avoid blindly entering trades when the price touches the trend line. Now let's look at another example. In this chart, I have already set up the stochastic with custom parameters. We can see a clear trend line connecting the swing highs, so I will draw it. Since the overall trend is down, we expect the price to drop from the trend line. Therefore, we only need to draw the trend line above and do not need to draw one below. Next, wait for the price to approach the trend line while the stochastic moves into the overbought zone. In this example, you can see that the price did not perfectly touch the trend line, but even slightly broke above it. However, this is still a valid setup because it remains within the trend zone. An interesting aspect of this setup is that the price area touching the trend line also coincides with a support turned resistance zone. This is called confluence and is often a sign that the price is more likely to drop because two key levels are converging. The final confirmation is to wait for the stochastic to cut back into the overbought zone. When this happens, I enter a sell order. Next, place the stop loss above the most recent high. Take profit at a level twice the stop loss. As you can see, the price dropped sharply and hit the take profit level. Now, there is another trendline strategy that I use, and this strategy can yield even higher profits. So let's move on to strategy number 2. This strategy works very simply. Assume we have an established trend line in a downtrend. Typically, if the price breaks the trend line, it signals a trend reversal to an uptrend. Since a trend line breakout means the downtrend structure has been broken, you cannot enter a trade immediately after the breakout. It could be a fake breakout. A trend line breakout may indicate a trend change. but it is not always reliable. Sometimes the price creates a fake breakout, making you think the trend has changed, only to reverse back. If you enter the trade and buy too early, you will suffer a loss. So, how do you avoid falling into a fake breakout trap? Here is the trendline breakout trading strategy that I use to generate significant profits. Identify the current trend line. In this chart, the price is in a downtrend and we have points that we can connect to draw a trend line. Wait for the price to break the trend line. To determine if this is a real breakout, we need to analyze market structure. Market structure analysis example: when the price creates a new lower low and then continues breaking that low to form another lower low, it indicates that the downtrend is still strong. However, if before breaking the trend line, the price stops making lower lows and instead forms a higher low, it means the downtrend is weakening. Confirm with a candle closing. When the price breaks the trend line, ensure that the candle closes completely above the trend line for a downtrend or below the trend line for an uptrend. Confirm signals before entering a trade. Only when there are enough signs that the previous trend is weakening and the price has broken the trend line with a clear candle closing should we enter a buy trade. How to set stop loss and take profit. Place the stop loss just below the breakout area. Set the take profit at twice the stop loss. Leave a comment below and don't forget to like and subscribe to StocksCK channel. Thanks for watching. See you in the next video.